What should you do when the stock market crashes? Stock market crashes can be some of the hardest times to be an investor, especially if you're just starting out. If you haven't been investing for very long, it can be pretty scary seeing your investments go down by 20, 30, 40, or even over 50% in the span of just a few short months. Earlier on this channel, I did a video going over many of the major stock market crashes the past 50 or so years. I went over how big of a hit the market actually took, as well as how long it took for the market to recover its previous high. I then extrapolated that information and discussed what would happen to someone's net worth if they sold their investments when the market crashed, in comparison to if they just stopped investing during the fall. And just to be thorough, I even went over what would happen if they kept investing the same amount or invested even more during the crash. And in that video, we found that most market crashes don't last too much more than 2 or 3 years, and some last even less. Now obviously there were a few exceptions, such as the dot-com bubble and the housing crisis, but most of them were not that bad or that long. We also found that by continuing to invest as much as you were prior to the crash, or even more than you were prior to the crash, could have a pretty significant effect on your net worth as compared to stopping investing during the crash, or even worse, selling your investments when they were low. However, one angle that I didn't really touch on in that video that I kinda wish I did was how much faster someone could recover their personal net worth during market crashes in comparison to the stock market itself. So that's what I'm going to touch on in this video. Today we're going to see how long it takes an individual's net worth to recover from various stock market crashes, using the S&P 500 as an example. I'm going to be looking at scenarios where the individual was investing 1 year prior to the crash, as well as 5, 10, and 20 years prior to the start of the fall, and show how, even though it might take the stock market, say, almost 7 years or so to recover, like it did during the dot-com bubble, it doesn't necessarily take that long for the individual to recover from that same crash. Assuming they keep investing, of course. Hey everyone, Daniel here, and welcome to Next Level Life, a channel where you can learn all about investing, debt, retirement, and many other general financial topics besides, because let's face it, the schools aren't gonna teach it for us. So if any of those topics sound interesting to you, or if you want to learn how to better handle your money and have more financial freedom, be sure to hit that subscribe button and the bell next to my name to be notified every time I upload a new video. And if you want to further support the growth of this channel, you can check out some of the links I've left down in the description below, which includes a 30-day free trial of Audible and a list of some books on money that I'd recommend checking out. Or you can just share this video with a friend and leave a comment down below letting me know what topics you'd like me to cover in future videos. So as you can tell, this video is going to be of the longer variety, and in the interest of keeping this under 20 minutes, I'm only going to be looking at 3 major stock market crashes. The crashes I'm going to be looking at are the crash of the 1970s, the dot-com bubble, and of course, the housing crisis. I chose these 3 crashes specifically because the max drop from the market's peak all the way down to its low point during the crash was over 45% in all cases. So statistically anyway, these are among the worst in the stock market's history. My hope is that by using specifically these 3 crashes as examples, in combination with the knowledge that we gained from my previous stock market crash video, we will be able to invest a little bit more confidently even during less than ideal times, because we know that we can recover from any crash. So without further ado, let's get started. The crash of the 1970s began in December of 1972 when the S&P 500 reached a peak of $118.05 before dropping to a low of $63.54 in September of 1974. That was a total drop of about 46.2%, and it would take the market nearly another 6 years to fully recover and set a new record high of $121.67 in July of 1980. In total, this market cycle from top to bottom back to a new top lasted for about 91 months, or 7 years and 7 months. But how much of a difference could an individual make if they continued investing during the crash? Let's take John for example. John starts investing $500 a month and decides that he will continue investing $500 a month regardless of what the market does. If he began investing in December of 1971, or 1 year before the start of the crash, by the end of the first year of his investing, due to the market slowly creeping up in that year, he would have a net worth of $6,461.87. That is, of course, when the market begins to tank. However, John doesn't really notice this. Not because he's not paying any attention to what the market's doing, because he is, even though he's not going to let it affect his decision to invest, but because his net worth is actually, by and large, going up. At the end of his second year of investing, he has a net worth of $10,649.71. This trend continues for another 7 months, where John reaches what was then an all-time high net worth for him of $12,800. At that point, the market's continued drops finally catch up with John, and his net worth over the next 3 months drops from that $12,800 to $10,800, or about a 15% drop for his personal net worth. Now, losing $2,000 off your own personal net worth over the course of 3 months is not necessarily an ideal situation, but considering that the S&P 500 at this point has lost 46% since the start of the crash, and John's net worth has gone up since the start of the crash, from almost $6,500 to about $10,800, he's not doing all that bad. In fact, he's up about 67% as an individual despite the crash. Now, he'd certainly be up even more if the market had continued to grow, but considering the circumstances and the fact that it only took him 4 months to recover his original net worth high of $12,800, he's doing okay. And of course, as it always does, the market itself eventually recovers, and John's net worth continues growing, but now at an even faster pace. And by the time the market fully recovers in July of 1980, about 8.5 years after John began investing, he has a net worth of $64,825, which means that in just 8 years and 7 months, John's average rate of return has been about 5.25%, which doesn't sound that great, I understand, but again, keep in mind, that's his rate of return during a major market crash. We haven't taken into account any bull markets that may have come afterwards. We just had him start investing a year before the crash, so he was basically buying at nearly the high until the market got back to where it was before the start of the crash. That's it. And he still managed 5.25% during that time. And of course, during that same span, the market gains very, very little, if anything, while John only sees a temporary 15% drop in his investments, which disappears completely in 4 months, and as I said, still earns over 5% a year. Those are the things to keep in mind. But while it is nice to know that we, as individuals, are less likely to personally feel the brunt of a market crash if we haven't been investing for very long, obviously the numbers do change a bit if we have been investing for a while. Let's say that John had been investing for 5 full years before the start of the crash. What would the numbers have looked like then? Well, we see that John has about $37,300 as a net worth when the market hits its peak, which actually ends up rising to about $39,200 due to the fact that the market didn't drop like a rock right away in this particular crash. However, when the bottom really does fall out of the market, his investment net worth drops from about $39,200 down to just over $27,000 in 11 months. It was a 31% drop, and John wouldn't personally recover from it for 7 months, meaning that the cycle, starting from when the market reached its peak to when John himself recovered, took about a year and a half to complete. And when the market itself fully recovers, again in July of 1980, John's net worth was just over $96,000. So again, during that time span, the market gains very little, and John sees a temporary 31% drop at his investments, which is big, don't get me wrong, but not nearly as big as the 46% drop the market experienced, and it disappears completely in just over half a year. And he still earns 3.75% per year during one of the worst crashes in the stock market's history. And of course, that's not counting, again, the bull market that did follow this crash, which saw the S&P 500 reach a value of almost $330 a share, which is about 2.5 times the value of the market in 1980, before that flash crash of 1987, which lasted less than 2 years. Anyway, the percentages weren't as good as in the previous example where John only started investing a year before the crash. But that kind of makes sense, right? Say if you had been investing $1,000 per year and buying 10 shares of a stock that was worth $100 per share for 20 years. You would have 200 shares, and those 200 shares would be worth $20,000. Then if the market crashes and those investments drop down by 50% the next year, you would still invest your $1,000, but this time you would buy 20 shares of the stock since it's worth $50 a share after the crash. And your net worth at the end of the year would be $11,000. meaning that over the course of that year, your net worth is down by about 45%. However, if you had been investing the same $1,000 per year into the same $100 per share stock, but for only 1 year, you would own 10 shares before the start of the crash, and those shares would be worth $1,000. Then if the market, again, dropped by 50%, and you invest your $1,000 in year 2 and buy 20 shares at $50 a share, that would give you a total of 30 shares worth $50 each, or a net worth of $1,500. So in that scenario, you're up about 50% over the course of a year, despite the fact that the market crashed, and it's because you're buying low while the investment is on sale, and because the amount you're investing, in this case $1,000 a year, is still a pretty sizable percentage of your net worth. And we see this mathematical phenomenon play out in each scenario, with the largest percentage drops in John's personal net worth getting closer and closer to what the market actually dropped as he's been investing longer and longer, but it never quite gets there because he's recovering some of those losses by buying more shares when the market's low. And the amount of time it takes for him to recover his personal net worth is also getting longer and longer, but again, never actually becoming quite as long as it takes for the market to recover. In fact, in the crash of the 1970s, even when John had been investing for 20 full years before the crash started, he still only takes 48 months, or 4 years, to recover his personal net worth, compared to the 7 years and 7 months that it took the market to recover. And we see this pattern continue into the dot-com crash. The dot-com crash began in August of 2000 when the S&P 500 reached a peak of $1,517.68 after a phenomenal run through the 1990s, before it dropped to $815.28 in September of 2002. That was a total drop of about 46.3%, and it would take the market another 5 years to fully recover and set a new record high of $1,530.62 in May of 2007. Not that it ended up lasting long, as we now know. In total, this market cycle lasted for 81 months, or about 6 years and 9 months, but the numbers for John look fairly similar, if not even a little better than they did during the crash of the 1970s. As you can see, the months that it takes for John to recover his personal net worth are a little bit larger than they were during the crash of the 1970s, and that's in part because the dot-com crash took quite a bit longer for the market to fully reach its low point than it did in the 1970s. But compared to the crash of the 1970s, it was a much, much slower climb back to the top of the market after reaching bottom. For instance, once the market got to the point where it had lost 40% of its value, it took 9 full months to get back below that 40% loss mark, and another 7 months to get past the 30% loss mark. The point I'm trying to make here is that once we got to the low point of the market during the dot-com crash, we stayed pretty darn close to it for a long time, at least in comparison to the crash of the 1970s. But what that means is that we, as investors, had many opportunities to buy our favorite investments when they were on a huge sale. And that's why you see such a big difference in the net worth figures at the point when the market recovers during this crash compared to the crash of the 1970s. And also, as you can see on your screen now, the housing crisis. The housing crisis, or the Great Recession, began in October of 2007 when the S&P 500 reached a peak of $1,549.38 before dropping to a low of $735.09 in February of 2009. That was a total drop of about 52.6%, and it would take the market another 4 years and 1 month to recover and set a new record high of $1,569.19 in March of 2013, which has been the bull market that we've been basically riding ever since. In total, this market cycle lasted about 5 years and 5 months, and as it turns out, it performed much like the crash of the 1970s when it comes to the numbers, just obviously with a bit of a bigger drop from top of the market to bottom of the market, and a slightly shorter cycle of recovery. But as a result, the numbers do look pretty similar. But that's kind of the point, isn't it? We've already covered how most market crashes don't last more than a few years, but as we see now, even the ones that do can be managed to a certain degree by just staying the course and continuing to invest. This is especially true if we've only recently started to invest, and even more true if we're just now starting to invest. So it's October 28th as I'm recording the audio for this video, and the market has been stumbling for well, most of October, with the S&P 500 being down nearly 10% from its all-time high that was set in late September. And on the off chance that the market does experience a crash in the near future, I figured it would be good to have this video in my log as a follow-up to the last one to help remind us that, even in the bad times, we can do fairly well. After all, like I said, when the stock market crashes, it's like we're buying everything in it on sale. And when the time comes that those sales end, our net worths are going to skyrocket. That's the takeaway I want you guys to get from this. From an investing perspective, stock market crashes are not a bad thing. And don't ever let the fear of one happening keep you from investing in the first place. As I said in my previous video, really the worst thing that could happen to you during a stock market crash is losing your job and not having the ability to get another one. And if that's something that worries you, I know, believe me, I've been there, then there are a few things that you can do. First is to obviously build up your emergency fund. Another, like we discovered in my last video on these market crashes, is invest more into the market during the crashes while you still can. And yet another option that not enough people take advantage of, I feel, is to diversify your income streams. Now, I don't know if that's just because people aren't sure how to do it, or if they feel that they don't have the time, or whatever the reason is, but I would highly recommend looking into it. Heck, I could even start making videos on the subject. I've been working on diversifying my revenue streams for nearly the past 2 years now, and it's really taking a lot of stress off my shoulders. And I think that, based on my experience anyway, it could for lots of other people as well. I mean, even an extra $100 or $200 a month, which really isn't that much when you get right down to it, could really, really help speed up our abilities to either pay off our debt, or invest, retire early, or even just have some extra fun money or vacation money. So would that be something you guys would be interested in? I mean, it obviously wouldn't replace these types of finance videos. I'd still do these like normal, but I could do those other videos in addition to the regular content. And I think it would really help round out the channel because thus far, I've only really focused on one side of the financial equation, which is the side where you're saving money through paying off debt and budgeting and those kind of things. But there are two sides to the equation. There's finding ways to save money, and then there's finding ways to make money. Anyway, I'm rambling on way too long here. This video is already too long. Let me know in the comments section below if that would be a type of content you'd be interested in seeing on this channel, in addition to the regular videos. But that'll do it for me today. Once again, if you enjoyed this video, be sure to subscribe and hit the bell next to my name so you'll be notified of all my future uploads. Due to my new schedule, I will generally be uploading every single Monday instead of Fridays now, just because that works a little bit better with my schedule. And if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.